Market perspective, I think this is the best news because you already know what worst you have to work with. So if it's a 25% tariff, the market will react to that. You've got the gift nifty already down by 200 points. It's indicating a gap down start. You also have the monthly expiry today. FIIs have already been selling India in the last 17 sessions out of the 22 in the month of July so far. FIIs have been sellers here in India equity markets. Well, sure, the DI cushion has been there. So all things indicating to a gap down start, but I think the markets will be very quick in also digesting and pricing in the worst case scenario, which is that 25% tariff. So you already know what worse can get to, and the markets should be quick to price that in as well. But let's pick up on that point forward. We've got Mitul Kotecha joining in from Barclays, and we also have Adrian Mowat on the show, emerging market equity strategist. Adrian, hi, lots to talk about. Let me come to you first. Tell me, how do you think, or how quickly do you think the Indian markets will digest this news of the worst case scenario of a 25% tariffs? While it seems like the negotiations are still on the table, one is hoping for TACO once again, but don't know what's going to come out of it.
I concur with your analysis that you sort of know the worst state, the 25%, and the market can quickly discount that. It'll have impact on specific companies. But for the broad benchmark, the composition of the benchmark, the sort of specific hit doesn't look that difficult to absorb. It's not a sort of direct hit on their earnings. We do need to sort of think a little bit more about capital flows to India. Does this indicate that the short-term Indian rupee weakness that we've seen will continue for a bit? It's quite possible that that's the case, and that might reduce the flexibility for the Reserve Bank of India. So I think we should, acknowledge, yes, worst case scenario, but we should also be thinking about the second order impacts of this quite aggressive trade policy against India.
All right, that's the take on the markets. But Mitul, coming to you, help us understand that what could it really mean for the Indian rupee? Can this trade deal really dent the weakness in the INR? Can we expect more of that to happen? And along with that, what can it really mean for the growth number for India? Can GDP be hit because of this particular announcement?
Look, I think reality is we know that President Trump will come out with such numbers. We don't know eventually if this is going to be the actual tariff implemented on India. We actually think we'll end up with something lower than 25%. Our estimate in terms of the growth impact is that say it is 25%, it will only necessarily have about a 30 basis point hit to Indian GDP. After all, India is still a relatively closed economy. It's not a trade-driven economy. It doesn't get hurt as much as a lot of the rest of Asia in terms of the impact of tariffs. So I don't think it's going to be consequential in terms of the GDP hit. I think in terms of the rupee, yes, the rupee has been under some pressure in recent weeks, even ahead of this deal. I think there's been nervousness because India was one of the first countries to begin discussions and is turning to be one of the last countries to get a deal on the table. There are clear sticking points, as mentioned, agriculture, dairy, etc. But look, ultimately, the rupee is starting to look oversold in our view. I mean, I'm not saying that we could potentially see a bit more near-term weakness. We could even see back to the February highs of dollar rupee around 88. But I think the technicals are starting to look overbought on dollar rupee. I think the valuations now are quite cheap on the currency, both in rear and near terms. We may be seeing a little bit of importer dollar hedging coming through, which is adding to pressure on dollar rupee. But on the other side, I would expect the RBI to cap any sharp slide in the currency. So I think for now, it's hard to reverse this move, but I also think that we're not going to see much more weakness in the rupee in the very short term coming through. And as for oil, I think one thing to look at as well is that India's already been trying to diversify its oil supply. It's been buying a lot of oil from Russia, 35 to 40% of that oil. It's saved in the last year around $7 to $10 billion from buying in Russia, but the discount that Russia offers has narrowed. And so I think India will start to look at other sources of oil, perhaps given this penalty that the US could implement.
Right, and Adrian, just to take that point ahead, right, we were just talking about India's recalibration in terms of their strategy when it comes to oil. What could that outcome look like? Do you believe that this could actually have the impact Trump wants to have on Russia, or do you believe that Russia could largely emerge unscathed out of this, or the Middle East stands to gain? What's your take on the entire penalty on oil that has been, because of oil rather, that has been imposed on India?
Frustration in Washington about the ongoing war in Ukraine and a recognition that Russia's balance of payments, Russia's cash flow has actually remained pretty healthy throughout this war, despite all the sanctions. And that this need, if they are to put real pressure on Russia to stop countries buying Russian oil, and the two countries that are buying significant amount of Russian oil are India and China. So I think this is a broader geopolitical issue rather than an Indian-specific issue. Clearly, the Trump administration's policy towards Ukraine has been, to be polite, fluid, but it does appear that they are getting a bit more hard-nosed when it comes to putting more aggressive sanctions on Russia. There's clear frustration from President Trump with regards to the behavior of Vladimir Putin. So I think we should be wary that the US goes ahead and, really gets quite tough towards India and China with regards to the importation of oil. So that is going to drive up energy costs. If you combine that with a weaker rupee, then that reduces the flexibility for the Reserve Bank of India to continue to cut rates and stimulate the economy. So I think these are important issues, and it's always the sort of second derivatives that you've got to think about in these situations rather than the things you can price very quickly.
Mitul, purely from a macro perspective, do you think the fallout could be the fact that FII flows may actually turn volatile? I mean, I was just counting as to how in the month of July alone, out of the 22 sessions, FIIs have been India sellers for the last 17. Also, that entire capital flight one is seeing, that risk only gets a little bit higher, and the kind of pressure that it actually puts onto the central bank, because they will have to ease their stance further than what they already have to try and, keep the demand afloat in the economy. Mitul?
Sorry, is that for me?
Yes, Mitul, that's for you.
Okay, so apologies. No, absolutely. Look, I think, I do agree. I mean, our house view is that the RBI will have to cut rates one more time. And we think that the inflation outlook is still very favorable. I understand that there may be that weaker rupee may add to some oil imported inflation pressures. But overall, domestic inflation has been very soft. The monsoon season appears to be favorable. Food prices have been coming off well. And we think that keeps a door open for the RBI to cut interest rates. And especially given, even if it's a limited impact on growth from tariffs, this could push the RBI into a little bit more action to cut rates at least one more time. Although that said, look, we've had very mixed comments from Governor Malhotra. It's not obvious that the RBI is immediately planning on a cut at the August meeting, but we do think there's scope there. And look, I think overall, as mentioned, you're absolutely right. FPI flows have been weak. Equity outflows in July have reached, $2 billion-ish. Bond inflows have been disappointing in recent months. That is a pressure point on the rupee, no doubt. And again, look, I think the RBI will still try and contain weakness in the currency. But for a real recovery in the rupee, we would need to see FPI flows pick up from here. And at the moment, that's still looking fairly doubtful in this volatile environment that you referred to.
So that will be interesting to see that how RBI takes and plans their action ahead. But let me also welcome on board Manishi Raychaudhuri, veteran investor in Asian equities. And Manishi, morning, not turning out to be a great morning for the Indian markets, rather. And a lot of these sectors, that is seen to be a bit concerning. So Manishi, firstly, help us understand that this 25% tariff implication, on which sectors it could really weigh heavy, and at least we can have some impact on the earnings as well.
Right. Thank you very much for having me. Good morning to you and our viewers. Let me make a couple of points. First, we must understand that at this stage, we don't have any details. We don't have any details about the exemptions, for example. Are pharmaceuticals exempted from this 25% as they were during the April reciprocal tariff, number one? Are electronic goods, which in many parts of the world with other trade partners of the United States are exempted, are they exempted for India as well? We don't know. So many of these details would possibly emerge going forward. And not only that, we don't even know whether this arrangement is permanent or not, because after all, the talks are still ongoing. President Trump himself said that there are more rounds of talks to be had. There's a sixth round going to happen in late August. So the situation is still fluid. It will obviously be a negative sentiment impact on the market. And if you look at India's exports to the United States, the big numbers really come from auto and industrial components, number one. Number two, on pharmaceuticals, which is about 8 to 9 billion. And, of course, garments and other leather goods and so on. So those are the sectors that come to my mind, which would possibly the most negatively impacted for now. I would caution about, actually doing the numbers at this point of time, because, as I said, we don't really know what is baked into these announcements.
Manishi, thanks for that view. Adrian, before we let you go, just want to get your quick sense on allocation changes. If the new tariff imposition, if it were to stay at this number, would that recalibrate the strategy for you? And on a broader sense, a large chunk of FIIs, given that other emerging markets like you have Philippines, Vietnam, now we have an announcement on South Korea, does the tariff number by itself change the strategy of FIIs in terms of their deployment?
I think it does at the margin. The delta here is negative. The delta is, as I said, feeding through in a weaker INR, potentially slightly higher imported inflation, and that reduces the flexibility of the RBI. When we were discussing a few months ago about the outlook, when you had a strong INR, good inflation data, then the central bank had a lot of flexibility to provide stimulus, and that was a bullish thing for the equity market. Our confidence in that bullish tailwind diminishes because of the events that have happened here, and therefore I would expect a negative effect on FII inflows in the short term as people reduce their allocation to India, reflecting a less attractive risk-reward environment.
Right. Okay, great. Manishi, Mitul, Adrian, thank you all of you for joining in with that quick perspective. Just can't get your eyes off from what the GIFT Nifty is indicating right now. Sure enough, a 200-point gap down start. And remember, today you've got the monthly expiry as well. So things in any case do tend to get volatile, typically on expiry day. We'll take a very quick break on that.